start with my literature review that I did a few months ago. First article by a guy named Cox. He explains how and why diversification of an investment portfolio is so important and the ways in which it is best accomplished. He discusses how to structure your portfolio as well as some good reasons to diversify, such as avoiding lumping all investments into stocks in case of a repeat of a catastrophic event like the 2008 stock market collapse. This is done by investing in other areas like precious metals or secure but lower return investments, things like U.S. bonds. McBride's article covers what induces price fluctuations in the gold market and how it's a place where investors turn when other markets may have turned volatile. There is an apparent negative correlation when one goes up and one goes down between gold and the stock market, since its price tends to dip when financial markets improve. Its price tends to go up when financial markets start to decline. The article presents the 5 ways to invest in gold. These ways are ETFs, or exchange-traded funds, closed-end funds, gold coins, and gold jewelry. The third article from Fidelity.com discusses the importance of diversification as the means of reducing the volatility of an investor's portfolio over time. It weighs the risks and rewards of being an aggressive investor at a young age with being a more conservative investor that seeks out lower but steadier returns later in life as retirement starts to rear its ugly head. The 4 primary components of a diversified portfolio are defined and explained. These are domestic stocks, bonds, short-term investments, and international stocks. In his article, Woolner, the article was called "Here's Why Diversification Matters" from U.S. News. He explains the basic idea behind diversification. Quite simply, don't put all your eggs in one basket. Instead of focusing on one area, investments should be distributed evenly between multiple forms of investments, such as stocks, bonds, and even cash that's squirreled away somewhere. The last article from the Graziato Business Review, this guy, Dr. Yavas, analyzes what are called market integration influences. He does research on markets, goes into the data and methodology involved, discusses his findings and results, and lastly, he gets into the stability of interdependencies among markets. Just shows kind of how all these different types of investments work together. So, the research hypothesis is maintaining a diversified investment portfolio is far more desirable than dedicating all invested funds into any one specific area, or even several limited but similar areas. And there's Warren Buffett agreeing with what the guy previously had said. Whatever you do, don't put all your eggs in one basket. So in this time of global economic instability, a diversified investment portfolio has never been more critical. Falling oil prices and slowing economies in China, other parts of Asia like India and Europe, make having a mix of investments absolutely essential to ensure that losses in one sector are somehow balanced out by gains in another sector or another form of investment. It is necessary to carry investments that maintain what's called a negative correlation to other investments in your portfolio, so that when an increase is realized in one, it normally results in a proportionate decrease in the other. Decrease in one results in an increase in the other, etc. This topic became of interest to me while doing research for a project about what's called socially responsible investing for my MBA 540 financial management class here at Wilkes. And it was interesting to me because I saw the way that different types of the dynamics between different investment types and how they interacted and how the different markets played into one another. So to support my hypothesis, I'm going to show some examples of different types of stocks to illustrate a negative correlation. I'm also going to show some examples of some lower risk, safer but lower return investments. And I will then analyze data collected from a survey of a number of Wilkes MBA students to determine their level of awareness of global economics, as well as to get a grasp of their understanding of investment portfolio diversification. The benefits of diversification, first and foremost, is to reduce risk. And this is done in several ways, such as holding different investments, again, against in different classes, different types, different stocks with different companies that have a different relationship, that negative correlation to each other. And you also want to hold investments of different types and also in different international markets, so that if one country's economy takes a hit, you'll be balanced out by another economy that may be doing or benefiting as a result of that. You want to be able to weather a financial storm. This is important because if, for example, all your money is in the stock market when it crashed in 2008, you would have lost, virtually everything you had invested. Having your investments spread into other areas can help you stay afloat until things, which they will, eventually stabilize. You want to be able to maintain liquidity. This is extremely critical to keep your investments in varying liquidity in your portfolio, because if everything is tied up in long-term investments and all of a sudden you have an immediate need for cash, you may not be able to come up with it quickly, or if it's some kind of retirement account, you could be penalized or even forced to pay taxes to the IRS on the amount you're withdrawing. Diversification can make you feel better. It'll reduce the fear of personal financial collapse, because diversifying an investment portfolio can provide that peace of mind, knowing that if one sector of the economy fails, funds should be spread out well enough that not all of your resources will be negatively affected. And then, when you get to that point, you want to make sure you kept your nest eggs safe. One of the biggest fears adults have as they approach retirement age is that they're not going to have enough put aside to see them through. Moving funds into low-risk investments like U.S. government bonds or like gold, doing that later in life will help ensure that there's something stored away to help carry you through. So an example of negative correlation, on the left-hand side we have ExxonMobil. Their stock price is a relatively good indicator of oil prices, a big global economic, one of the biggest global economic indicators. We have this contrasted against on the right, the Hasbro company, the Hasbro Corporation, who's a manufacturer of toys which are made primarily from petroleum-derived plastics. This clearly illustrates a negative correlation. Hasbro uses the oil to make their products. As the price of oil goes down, their profits shoot up. They make more money selling their goods for the same price for less cost. And on that a little bit, again, we have Exxon on the left. On the right-hand side, we have three airlines. We have United, Delta, and Southwest. And as you can see, the price of oil drops. The cost for the airlines of jet fuel drops. Their profits shoot up. And as a result, their stock prices shoot up. So weathering a financial storm, This chart shows the yield for a 10-year U.S. bond, and while the yields are underwhelming at best, the drop, as you can see, it's been relatively slow over the last 25 years. But what makes these bonds so appealing is that there's virtually no chance of default on them since they're backed by the federal government. It also helps that a large portion of these bonds are owned by foreign investors. I think it's about 30% are owned by foreign investors. This means that in their best interest, these foreigners also want the U.S. economy to stay strong, so it's their money too. They want to see their returns increase. In our next example of weathering a financial storm, it's just showing the price of gold over the last 20 years. It has gone up significantly, but it has been a slow climb. The slow climb will kind of show you that the decline will also be slow. It's kind of peaked and it's kind of plateaued. But it has that inverse relationship to the stock market, and you can sell it off pretty much at any time. So it's very liquid, and that inverse relationship to the stock market means it's somewhere safe to keep your money should the stock market go in the tank. And it makes it a safe haven for investors in turbulent financial times. So for my data collection and preparation, I sent out a link to a survey hosted by a site called surveymonkey.com to about 40 Wilkes MBA students. I did only receive about 15 responses. It was fairly adequate. The data I got back was very helpful in putting these categories together. Some of the hypothesis tests suffered a little bit due to the small sample size. The survey collected information, demographic stuff about their age, their career stage, some financial data such as their income level, their desired return on investment, and monthly disposable income. I also gathered some data just about their awareness of changes in the global economy, as well as their general understanding of diversifying investments, as well as some of their tendencies. Will they do it later in life? I'm going to present this data in graphical form, and then use that data to perform hypothesis testing, which hopefully will illustrate what effect demographics like age, income level, and career stage may have on their level of understanding of diversification. So here's my Excel spreadsheet that I populated with the data I gathered through SurveyMonkey. Age range, career stage, income level, their estimate of the disposable income, desired return, generally just awareness of global economy, how familiar with it, how close they pay attention to it, how they would react if they invest or plan to invest in response to changes in the global economy, general understanding of portfolio diversification, and then would they consider moving into lower risk investments as they approach retirement age. Some graphs of demographic information. On the left, you see the age. Okay, so for our first hypothesis test, we're going to check to see, we're going to use a one-sample, one-tailed test for the proportion to test the hypothesis that respondents are over the age of 25. And as we can see from the data gathered, since observed is less than critical, and since the p-value is greater than alpha, in this event we're going to accept the null. Most respondents are not older than 25. Next, we're going to look at the career stage to see if most respondents are in the establishment or entry level of their career. Again, using a one-sample, one-tailed test for the proportion. In this case, observed is greater than critical, and p-value is less than alpha. So here we are going to reject the null. What we take from this is that most respondents are in the early stages of their careers. So next we're going to look at the respondents' awareness of the global economy, how closely they pay attention to what's going on financially around the world. So on the left-hand side, it appears that most younger respondents either don't follow it closely or only follow it somewhat. On the right-hand side, it looks like older students seem to pay closer attention. So for this example, we're going to look at a two-sample, one-tailed test to check the hypothesis that older students are less likely than younger students to follow happenings in the global economy. Using the results gathered, observed is less than critical, and the p-value is greater than alpha. So here we are going to accept the null. Older students are, in fact, more likely, for whatever reason, to follow the global economy than younger students. Next, we're going to try to get a gauge on understanding of importance of portfolio diversification. So on the left-hand side, we have those in lower to mid-income levels, and as we can see by the graph, most are either have no understanding or are not very familiar with diversification. On the right-hand side, we see mid to higher income, that they are either relatively familiar or fairly familiar, with a smaller portion being not familiar. So for our test to analyze this data, that students, and we're going to test the hypothesis that students with lower incomes are not as likely as those with higher incomes to understand the importance of portfolio diversification. We use a two-sample, two-tailed test for the proportion, and we see that observed is less than critical, and p-value is greater than alpha. So here we are going to accept the null. Even though the proportions show that sample 2 was slightly higher, it's too close to be significant. So therefore, students with lower incomes are as likely as those with higher incomes to understand portfolio diversification. We're going to discuss the respondents' concern about investment risk later in their career. So on the left-hand side, we have those that are early in the early stages of their career, and as we can see from the responses, it's primarily either no or not sure. As we can see on the right, those in mid-career, they're sure about it. 100% of respondents said that yes, we will move to lower risk investments as we approach retirement age. To back that up, that those in early stages of the career are not as likely to move to lower risk investments as they approach retirement. We're going to use a two-sample, two-tailed test for the proportion. As we can see, observed is considerably higher than critical, while p-value is considerably less than alpha. So here we are going to reject the null. Those in the early stages of their careers are not as likely to move to lower risk investments as they approach retirement. So just to sum it all up, most respondents were 25 years old or less. Most respondents are at the establishment stage or entry point of their careers. Older respondents, for whatever reason, appear to be more aware of changes in the global economy. Maybe they read more than the younger respondents, who maybe they have more going on in their lives. Income level does not have a significant effect on understanding of the importance of investment portfolio diversification. And lastly, younger respondents seem to be more aggressive in investing and less concerned about retirement, which for them seems so far away. In conclusion, we find that diversification is extremely critical in a volatile and global environment, especially like things like the 2008 stock market crash could seemingly happen at any time. The Dow Jones averages down all over the place. Um, it's a relatively basic concept. Don't keep your eggs in one basket. Spread things out so you're safe if one thing goes bad. You have other things to rely on. I think the data collection hypothesis testing indicates that Wilkes MBA students do have a pretty good understanding of the concept of diversification. And as we could see with the decision to diversify and put funds in lower risk investments as they approach retirement age, the younger students, see the importance in that yet. So demographics do play a significant role in that. So for recommendations, if you're considering investing or you are currently investing and you want to diversify, you want to find out more about it, um, definitely contact a certified financial planner who will be able to point you in the right direction and be able to show you, how to spread things out. Um, be aware of the global economy. It can have a dramatic impact on your portfolio. Things like oil prices, gold prices, uh, foreign currencies, that sort of thing, all interact with what goes on. Um, and retirement, whether you're 18 to 25 or 35 to 46, it comes on fast and it'll be here before you know it. So I can see when you're young being more aggressive, maybe put a little bit aside earlier on. And some limitations I ran into with the project. The survey, I probably should have sent it out to more people or maybe started it much earlier on in the project to have gotten a greater sample size. Um, it did sort of have an impact on my hypothesis testing. I feel would have been more accurate had there been a greater amount of data to work with. The way I did this, I narrated a PowerPoint slide and then converted it to a video. That process takes a while, even on a newer computer. Hosting it on YouTube, anything longer than 15 minutes, you have to verify. You're only allowed 2 of those per year per account. So you might want to look into a different means of doing it than narrating a PowerPoint. It does work. There was some added time stuck in there between slides that I couldn't avoid. So the actual overall running time was not what it should have been. It should have been a bit less, but it did work. I would just say it was cumbersome. Thank you.